Question number one. I'm a first-time investor. I have not done a deal yet, and I'm hearing a lot about mortgage rates increasing. Is now still a good time to invest in real estate? This is Colin from Minneapolis, Minnesota.
Well, yeah, first of all, the assuming that you're doing this with the mindset of doing it for the rest of your life, and you've heard that mortgage rates are increasing. Now, maybe by the way, they've actually come down a little bit of late. But if mortgage rates are increasing, then now would be your time to lock one in. If you're getting a fixed rate mortgage, then if they increase after you close on that mortgage, you don't get affected by that. So if rates are going up, and they probably are over time because they should, if you have an opportunity to lock in a 15 or 20 or 30-year rate right now, well, then you're going to be happy because a year from now, everybody else who's investing is going to pay a higher rate. So on its face, it's a good time to invest. But in general, accumulating real estate in this country is only a bad idea, assuming you can afford it, assuming you're not stretching yourself too thin. But if the question is, I've got my down payment saved, I'm ready to take this plunge. There's only been a couple of times in history where it wasn't a good time. Now, you get into micro markets where, meteor strikes and it makes the real estate less valuable. That's different. But overall, we went through a housing crisis 10 years ago, and there was a peak. It had gone up too high, and then it crested and it came down until it got back to where it belonged, and then it got back onto a nice steady incline again. So you can have bad timing if the market's about to crest and go the other way. But I'll tell you that there's really no indicator right now in terms of the national market. And again, pay attention locally, because if you're investing somewhere where there's an anomaly happening, you're going to want to be aware of that. That could cause prices to go down. The major employer in town is shutting its doors, for example. Don't invest in that town, right? But if all things being equal and things are normal and population is stable and ideally it's growing and it's a popular place, then it is a good time to accumulate. Okay. And even if you bought at the very peak in 2006, you made your money back. So again, holding, I've talked with you before about the idea that timing is everything. But really what I mean is that put a lot of time into your strategy, let it manifest itself over decades. And so even if you do wind up making a timing mistake, the market will pull itself out.
Right.
Nothing on the horizon right now, and nothing happening in terms of the market activity on the ground today that would give anybody an indication that the market is reversing itself. What's happening in the market is that it's quieting down, which is good. The appreciation has been a little bit too steep for a few years. After that happens for a while, the healthy thing is for it to cool off. If it goes too hot for too long, then it's going to have a freeze to calm it down, right? That only happened one time in the last 60 years. And so people have it in their mind that what goes up comes down in real estate, but it really doesn't in general terms in larger geographic areas. Again, micro markets could be, but you can avoid that by knowing what's happening. But I like the idea, if you're ready, if you've got your money down, your down payment saved, and if you're going to buy something in a responsible way, that you're going to be able to rent it out for a healthy profit, which means you can hold on to it for the long term. Rates going up is only an advantage if you can lock one in.
So I agree with what you're saying about buying for the long term. That absolutely must be the case. And the one time that housing took a complete tumble was when there was a lot of predatory lending that was going on, right? A lot of it. And that, do we see that today? No.
No. That's it. That was the only ingredient that caused it to go haywire. And just let me map it out for people. Back in 2003, 4, 5, 6, the lenders, driven by the government really, were giving people money that they didn't qualify for. They were giving, if you could qualify for a $200,000 loan, they were giving you a $300,000 blank check to go spend. And so naturally, people believed they could afford it because the bank thought they could afford it in theory. And they were bringing those blank checks out, and they were getting impulsive, and they were driving prices up artificially, just like the price of college is artificially being inflated right now by funny money in the form of student loans. Home prices were inflated by funny money in the form of loose mortgage standards. That doesn't exist right now. So the mortgage standards are still fairly tight. So that's not part of this right now. So if we see it in the future, we'll be quick to warn everybody about it and then tell you to hold off. But right now, the market is behaving in a very unsexy, boring, kind of lumbering way, which if you've got a long-term plan and being wealthy 25 years from now is sexy enough for you, then it's a good time because nothing scary is happening.
The only thing that's scary that's happening is is media painting a big red arrow in the downward fashion. That's the only
Yeah.
thing that's scary.
Yeah, and they've got their biases on both sides. But at the end of the day, that's why it's important to understand this for yourself. People are buying houses because they're confident in their jobs. People are buying houses because they're just millennials are getting older and now they're getting ready to do these kind of things. So the market's performing the way that it should, and that's one of the things that makes it such a great investment is that it's non-volatile. It's not like the stock market where somebody, makes a misstatement in the media and the stock market goes down 500 points. That doesn't happen in real estate.
That's right. I think at the end of the day, you have to ask yourself one question. Well, maybe two questions. And I may have said this on a previous Think Realty radio show. I can't remember, but I'll say it again. Number one, do you believe in capitalism? Okay, great. Number two, do you believe the United States of America is going to continue to be a superpower in the next 200 years? If the answer to these questions is yes, then you should be
buy
buying
some.
property.
Yeah.
Right. Otherwise, yeah, you're right. Right. Otherwise, go to like India or the Philippines or Australia or somewhere else to buy property. But it doesn't make any sense. Why would you do that when you're standing in your own acres of diamonds, which is a great book, by the way. Everybody should read this one. Next question, William from Orlando. I've been flipping homes and doing well, but really want to start buying and holding rentals. I'm thinking and hearing about apartments instead of houses for that plan. What do you think?
That's a great question. And I think a lot of people are attracted to apartments because when you buy apartments, you can get, you're buying more property in one location. Okay, so the management function can be easier because you have 4 or 10 units under one roof. It becomes an easier management function. It's one of the reasons why I wanted to do this deal with Renters Warehouse, because if the management function is easy for you as an owner because somebody else handles it, all the better. But here's one thing, because it's residential real estate in either case. All right, but here's the big differentiator. A house has 2 uses. It could either be owned as an investment, like we're talking about, or it can be owned as an owner-occupied home ownership house. And so if the economy is doing well, later on in life you want to sell the property, okay? And along the way the property value is being driven by essentially home ownership. So if you own an apartment building, you can't sell Unit 1D to somebody who wants to own it. You got to sell it all or none. But if you own 10 houses, you can decide to sell a house because that house, you want to cash out of that house, keep the rest. Mm-hmm. Or if the economy is doing well, prices are going up because home ownership is in demand. If the economy is doing bad, rents are going up because home ownership is declining. And so the single family home having kind of a two-faced coin, a two-headed coin, gives you the ability to hedge against the economy going in either direction, because you can change you could sell it to an investor or an owner occupant or keep it as an investment. You have more options to manage your risk in the future.
You have more exit strategies available to you, and that is absolutely the name of the game right now. Absolutely the name of the game, and that's why I like single-family rentals, right? It is the most liquid form of an illiquid asset class.
Right. Well said.
Right? And it gives me that sense of comfort that, all right, I'm putting down 30%, 35%. I have a long-term strategy. And if I need to sell the asset, I can. Worst case scenario, I can sell it and I'll still be okay. Best case scenario, I'm sitting on 5 or 10 or 15 properties over a 10-year time frame, and over these 10 years, I'm paying each of them off. The tenant is doing that for me, and my cash flow increases. I get the opportunity to claim depreciation. I have equity component. I have an appreciation component. And most importantly, I can leverage these properties. It is a total, absolute winner. And if you're not paying attention to a long-term strategy here, I think you're losing the game.